side. So first and foremost, traders, I want to welcome you to today's webinar event. My name is Sean Kozak, obviously the CEO of the NeuroStreet trading ecosystem. I've got my Director of Education, Jim, here. He'll be assisting me in the presentation. And we're really, really excited for today because we've been waiting for some time now to be able to essentially host and showcased a joint venture partner of ours in the business, none other than Rocket Scooter. Now, there's a story behind Rocket Scooter and how I kind of came to learn about what they're doing and their team and how they approach the market from a technology side and a trading methodology. And it's actually nothing short of insane. I mean, what they're doing is game changing. I truly think that the title of their presentation is exactly accurate. They are the only company in the business that I've been able to see that's been able to accomplish, yet alone do successfully what they're doing. And hence why I wanted to bring them in and actually host them in our ecosystem. Now, a little bit of a backstory. Matt and his team met with me. I learned about Rocket Scooter through one of our staff, and they said, you know, Sean, you should check out these guys over at Rocket Scooter. Like they're really doing something incredible with options level data, and it's applicable to multi-asset classes. They've got their own platform, and I took a look. I started watching all their videos. I met with their team. I looked at their technology, and I was like, wow, man, like these guys are doing something incredible, unique. Nobody else is doing it, which is really, really unique. And it's highly successful, which is really what's more important, right? Like having a great product is one thing, but is it actually successful? And so once I started doing some more research, I was blown away. And the key here is that they are going to provide you with some keynote and details of their secret sauce pertaining to options level data from a market maker's level. They're pulling information that nobody else has. Trading platforms that you're used to doesn't have access to it. And they're able to identify stuff that truly the big boys are doing, right? Like the market makers, the guys that are creating the liquidity in the business, how they're hedging the market, and how that translates to where you should be trading, whether you're trading futures levels, stock levels, you name it. You can take what they're doing and articulate that into the day trading realm. So without further ado, we'll be in the background answering questions where we can. We'll record this event, send it out in a post email so you guys can get access. And they've been so kind to give us a discount for our community should you guys choose to do this, because I can assure you this is game-changing stuff. And I'll turn it over to Matt. He's the CEO of Rocket Scooter, and take it away, Matt.
Hey everybody, welcome, and we're glad to have you here. I just want to introduce myself. My name's Matt Coward. I'm the founder and CEO of Rocket Scooter. We are a technology company for trading. We've made a trading platform, and as was just mentioned, we have a unique technology for traders that nobody in the industry has even come close to creating something for. The name of the game is tech race, right? Out there, all the people that you're trading against have sophisticated technology that as the days go by, retail gets pushed further and further behind the curve as far as knowledge and data you have access to. Our background in the company, myself and some of the original partners were engineers. And so Rocket Scooter is a nod to our engineering background, where the engineer's mindset of trading is to look at substantial data and find things that make sense. And then, of course, give it to you on the retail side of trading in a way that's easy to digest. So how do you take complex information and give it to you in such a simple way for you to understand and be able to utilize it? And Rocket Scooter, the name, scooter is the kid's toy that you pedal with your feet. We strap a rocket engine into it so that it can go to outer space. That's our engineering add-on to the basic thing that's already out there, traditional analysis methods. And the elevator pitch clearly, just like one sentence, is that what we actually do that nobody can do is we actually have an algorithm that can sift through all the options data that exists, every options trade that exists. And we have models that model what market makers and major banks are doing in large institutional positions. We can filter out all the options data just to find out where the house is positioned. You're betting against the casino long, someone else betting against the casino short. How do you know what the casino's risk is? Because with that information is the power that we give to you guys. And I'm going to show you how we do it and what we do that's differently. There's a lot of options and options flow and order flow technologies out there, but none of them have the ability to extract what dealer positions are from. And that is what our sauce is. It makes this thing very special, what we made. Let me go ahead and kick through the slides really quick. Oops. So we have a trading platform. This is what it looks like. It's pretty much your traditional platform. You've got charts, watch list, scanner, all kinds of neat things that are displayed, very easy for you to see. We have a training program that goes over how to utilize this data. And so this is kind of a 3-chart setup. We actually do live trading on the platform. We have a scanner and all kinds of neat features. We'll kind of go over that in a second. So as far as like what retail traders' biggest problems are, every single day that you are out there trading, somebody's getting faster and better. And most of the technical analysis and things that you might have been using were invented in like the 60s and 70s. And right now you've got companies that are setting up across the street from the exchanges with radio towers on top of the building just to get there a millisecond faster. You're falling further and further behind every day. And the tools that used to work a long time ago just don't really have that potential to get you to that next level, or even like have edge that can even compete against these algorithms that you're trading against. You're basically showing up to a gunfight with a sharpened stick these days, right? Banks have the advantage. They have, all the ability to know your order flow when it comes in, even before the orders are filled. You're always being traded against by the casino. And that's the hardest thing as a retail trader to absorb, because it's a very unfair game designed to squeeze everyone out. So modern tools need modern behaviors need modern tools. Since market makers and banks run these large quantitative algorithms, we've one-upped them and created ways to figure out what they're doing through a very sophisticated process. And then of course, deliver that information to you guys. And the last part is that we've made learning kind of simple. The way that you can see where the banks are flowing, where the bank's risk is and where order flow is moving markets. We give you, it's as very simple as we draw arrows on the chart to show you that general direction of where things are being pushed. Inside of our platform, we have 15 different tools, and each one of them exploits something different. Not just the options order flow stuff or the market maker positions and bank positions. We have all kinds of other stuff that we do as well. So not only do we come with the tool set, I'm going to talk about that one first. Even going further, we have something for everybody. We have all kind of volume prediction techniques, algorithms that track the market. We have ways to exploit any kind of arbitrage between index and the stock they're tracking, and a lot of neat tools as we continue to one up what's out there and make new creative and clever things for retail traders to go into the platform. So the master tool that we have is called a liquidity map. And a liquidity map is a very, very, very simple to understand thing. If you just want to take it for what it is. Anytime you buy a stock, right? Traditionally, I'm going to draw on my screen, you're going to long a stock, and you're not really going to have a trader on the other side of your trade that is another retail trader. It's usually going to be a market maker jumping in the middle who will short to your long. And then somebody else who's selling to the market, they're going to long to that seller and neutralize themselves out, connecting the dots. Now, in the moment before buyer and seller find each other, the bank is exposed to a little bit of risk. When I say bank, I mean market maker. And so at all particular times, the banks have a balance point where they're balanced, and they have a place where they're taking on water to the long or short side. The bull zone and the bear zone is what the liquidity map is built on, that foundation. In every single options position that's out there, in the moment that a bank has short exposure to you as a long against the house, imagine this is the casino, right? You bet, and the casino is on the other side of your bet. When they're short, they temporarily are going to have some calls to go with it. Short is market goes down, you make money. Calls is market goes up, you make money. Those things neutralize out to zero if they're balanced correctly using the Greeks. So in the interim, market makers are going to take little side bets and options to balance out the risks they take selling and buying stocks to you. In knowing where those calls and puts are held by dealers, our filtration process lets you know the bull zone is where the actual bulls are trading against the house, and the bear zone are where the bears are actually trading against the house. And in something as broad as the QQQ, you know exactly where the bears are winning the game and where the bulls are winning the game, and when the banks are balanced against the two of them. Very, very, very important statistic. Now I'll talk to you about a back test that we've done. This is a statistic, and under certain conditions inside of our platform, let me tell you how strong this correlation is. In the daytime, whenever the S&P opens in one of the two zones, bear or bull, it doesn't matter. As long as certain conditions aren't met, and we have an alerts thing in our platform that show you those conditions that you can open up, as long as none of those alerts have flagged off, If you open in the bear zone, 96% of the time, you end up in the bear zone at the end of the day. 96%, and that's from a back test, multiple back tests, actually. We just did one yesterday in our Discord and brought up those same numbers. So under a certain amount of conditions, and again, when they all line up, we have little green and red lights on the platform that tell you when they line up. If you open in bull zone, 96% of the time, that's the low of the day. Imagine knowing where price likely won't go if you're an options seller. That's golden information. So that's the first part of what a liquidity map is, and again, I'll just show you an example with QQQ. You see how it's rallying up and it's making its way back into the same zone it started in, right? This has to do with it just being a sheer large amount of risk that exists in the market that has a hard time toppling without a catalyst or an event or something to really kick the market over. In a normal ebbing and flowing day, things are going to move and kind of ebb and flow. You know not to chase this long because it's a bull trap, right? So bull and bear zone have to do with where you are positioned against the dealers, and the dealers buying those options from option sellers is what this hedge pressure number is. And hedge pressure is the net gamma maximum of options sold to market makers of the stock by dealers of the option themselves. And we have another filtration process that does that. Hedge pressure is a net pressure that just pushes the market away from itself no matter which side you're on. And under those same conditions, what we found out is that in certain markets, it's between 10 and 20% of the time it ends up on the other side. So about 80 to 90% of the time, if you open above the blue, you also stay above the blue. So when you look at both of the first two things I said, you know that you have pressure pushing up, pressure pushing down, and all things being equal, the market just isn't going to spontaneously throw the dealers upside down. They're going to maintain balance and order unless a catalyst or an event creates a big move. And that's not really happening every day, as long as you're not trading around news events or, you know, you're something that's on the calendar or in big announcements, earnings, whatever. The market's going to ebb and flow as much as possible to the net sum of least risk of all participants, i.e. the maximum squeeze point of your meet. You always feel like you're losing as a trader. So is everyone else, because the dealer is always winning against the maximum amount of people that are losing. So let's get on their side. And that was the whole point of creating this. So if you match up what these letter codes show you, it just kind of off to the side gives you a net pressure of where things are going to flow. And as you see, there's a little bit of a guideline here, whereas market can open and support it blue back to open or trade up to the next resistance, which is here. Both of those legs of the trade appear exactly right there in the little guideline. Now, again, it doesn't predict the stock market. It's just like a wind that's constantly blowing. And so we make our trades and bets along that wind as well. Markets are falling here. I'm not taking a short. I'm going to probably buy with a stop loss. I know that I'm probably going to trade it there as my exit target. Now I can actually say I have a reward to the risk that I want to take. And now I can actually calculate risk and reward before I ever make a trade. And that's the one thing that was always missing from my diet as a trader until I built it for myself. And then we built this massive community on that framework. How do you know that it's a 3-to-1 or 4-to-1 or 2-to-1 trade before you make it? Well, you know where those pressure points are. You know exactly where you can trade within that range. And so liquidity map is a neat little way for you to be able to get any stock, any index, anything that has options and see where the dealer's position against you, me, and everyone else. What is my typical stop size? So typically on a stop loss, any pivot that you're looking at, a stop will be 1 strike distance below. An example with QQQ, the strikes of options are 1 point apart. So I would typically put a stop 1 strike below my bounce point just to account for any possible noise. As you see, sometimes there's a little bit of noise. So our rule, as a rule of thumb, is 1 strike away from any pivot. Okay. So let me show you a couple more things. Let me go here. Let me get my drawing tool out. So by the way, if you guys have any questions, feel free to always just phrase them here and we'll feel free to answer them as well. So in the liquidity map itself, let me go ahead and exit this and pull up the actual drawing. Liquidity map is a thing that we give you that each letter code has different series of pressure points that we can trade against. So anything from Tesla stock to Apple stock to S&P futures to anything, I'm using this on a daily basis. And so whatever the code is, that's what you see. And I think like today, let's pull the platform up. Here's today, right? And this is what the actual platform looks like. And so as you see, now we're in a different map right now. BSD is telling me that blue line is resistance, and that blue line is resistance, as you see right here. When we broke through, it continued to sell off. It's showing you that net pressure to that downside. And right now it's actually flipping like it's going to try to break on the other side. So you can see how the map will change if you are moving to the other side as well. Long story short, you can type in anything here. It'll give you that same map. Let me put up something like Tesla stock and then see what you got. Tesla right here, there's that blue support that pushes up to resistance. Here's that blue support that pushes up to resistance, just like that. Longing on hedge pressure on a BLU is one of our favorite trades to actually make. A nice, clean, long trade out the door. These things print out at 9:30 in the morning, and they stay the same all day long, and then they're actionable until 2 p.m. And that's kind of the sauce of how that works. Bull and bear zones, hedge pressure, monthly hedge pressure, and the map is the sum of all of those pressures together. And think about it, like, as an engineer, you think water flowing through pipes and stuff, it kind of goes to the least pressure, right? And so we try to think of order flow almost like a fluid in that same sense. If the dealers are trying to minimize their risk, they're maximizing your risk, meaning that you lose the most for them to neutralize themselves. And that is a powerful piece of information as a trader. Isn't that correct? For them to be neutral, they're neutralizing one trade with another, which means both other sides of those trades are somebody's losing to them each. So for every neutralization point they have, two people are basically losing to them. Does that, and you start to feel like, yeah, man's game is rigged against me, right? So this is why we created tools like this. So this is called Liquidity Map, and this is one of the 15 major tools that we said we have. Kind of going to the next layer of that. We have a ratio. It's called the DD ratio. It's a whole different kind of indication, but it's a neat thing that we can use for the actual overall health of the stock market in general. It's one single number at the top of the platform that tells you the actual path of the market itself. Now, if you remember, we were talking about bull and bear zones earlier. Here's an example. Tesla is in a bull zone. And we know that bull zones tend, if it opens in bull zone, it's typically going to support in a bull zone for the most part. So what if you took all of the stocks in the S&P 500 and you took a ratio of how many stocks are in the bull zone versus how many are resisting the bear zone, and you weight it by market cap, then almost the structure of what the S&P is going to follow. If the majority of the stocks are in the bull zone and the majority of the market cap is in a bull zone, then the S&P is not likely to crash under its own weight. It's going to support itself more than anything. This DD ratio, if it's greater than half, the market generally is bullish. If it's less than half, the market is bearish. And so back in the day, when we had that recession, right, or the market sell-off in the middle of this recession we had, the minute we hit the bottom in October of 2022, that DD ratio has not dropped less than half to show bearish, except for 2 days in an entire year. While everybody is doubting that move up, this ratio at the top, 98% even to this day, is so strongly bullish. One number, one path. And it has been bullish, 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 bullish ever since. Even through this, it's still never wavered to show a bearish number, because it is the purest bias of the market. The S&P tracks the sum of the stocks. If the sum of the stocks are in call territory, then the natural flow is that call sellers are forced to buy that stock because those calls are in the money. So why are people still longing and chasing at highs? Because 98% of the market cap, 97% of the market cap of the S&P is in a territory where calls are running the market. Call sellers are forced to buy. And it's another very, very, very powerful piece of information. Okay, I'm going to load up something really quick. And I like to do this. Actually, I'll bring this up in just a second. We utilize some of these tools to make major pivots and calls in the market. I wasn't prepared to kind of show this, but let me go ahead and get this up really quick. Let me go really quick. And I'll save. Just bring up this really quick. Okay, let's see if I can get this up here. Let me see if I can't find it later. I'll probably think I can find it out. Okay. Anyways, so DD ratio on top of liquidity maps are two of our major tools that we utilize on a daily basis. So the next one, let me go through here. A little bit of what it is. It's just a number greater than half. The general bias of the market is bullish, less than half it's bearish. And even through those 2 or 3 months of selling after the Fitch downgrade, our ratio never once dropped below half, which is a good piece of information. We knew that at some point it's going to turn around and get back to being bullish. Okay. Resilience is a tool that we created, again, for the indices that helps predict the gap. The gap is anytime the stocks open or close at a different place in the previous day that it opened or closed, you have a gap that exists in the market. Gaps take place every single day. Markets will open either above or below based on sell imbalances from the previous day and in the morning, buy and sell imbalances. And so we created an indicator that looks at the arbitrage between what the actual value of the S&P is versus the market cap weighted sum of the stocks flowing through their gaps as well. If stocks are gapping and going, then the S&P is likely to gap and go. If the stocks are gapping and fading, the S&P is likely to fade as well. The redistribution zone is where the difference is between where you open and close. And resilience is a very cut and dry indicator that tells you, is the S&P going to fill its gap or is it going to gap and go? And so this particular example of the trade, the previous day we closed higher than where we opened, so we gapped down and the S&P started trading lower. As you see right about here, this resilience indicator goes above zero. It's just an oscillator. If it's above zero, then the seesaw is slightly tilting to one side, to the upside. If it's less than zero, it's slightly tilting the other side. So as the S&P is trying to sell off, right exactly here where my mouse is, right at this S, right here, the resilience number showed that the stocks were starting to move when the S&P wasn't even moving at all. They didn't give you any indication, that it was moving, but the stocks do. So you can now look at the index and see that, okay, the stocks are actually continuing, they gap down, but they're filling their gap and continuing to go. And then right out of nowhere, the S&P immediately caught up. The takeaway is resilience is a leading indicator under ideal conditions, which we talk about in our training, what they are. And so in this particular instance, probably 20 minutes ahead of the move, you knew that the stocks were going higher. And if you were trying to short this, you had an indication that you were likely going to get squeezed. Does everyone see how that works? It's just a simple indicator. If this is above zero, the S&P moves to the top of this box. If this is below zero, the S&P moves to the bottom of that box. And another neat thing is that even it gets a little confusing because there's a lot of new tools. We give you little cheat sheets that help you understand what each indicator is trying to do. In this particular example, there's that box. And if you're trading below the box and this resilience number is greater than zero, it just wants to push to the top of the box like you see right there in the example. So you get these little cheat sheets when you actually do use the platform as well to kind of help you remember what each one of them does. And there's the example of being below the box, it pushes to the upside. Being below the box pushes to the upside. Being below the box push to the upside. See that draw for it to fill its gap that way? Each time resilience didn't fall below zero. So as it's trailing down and selling off and down here, this is above zero. And again, it's a leading indicator for you to take a long there to trade right back to there. Again, with a stop, risk and reward, same as you would do. See how that works? And these are recent examples. I think this is probably from like a couple of weeks ago. Every single day I wake up and I use the DD ratio, resilience, and liquidity map, and I trade only with those things. I don't use any multi-time frame analysis. I never change my charts to like look at multiple time frames. We eliminated the need to do that. It makes it trading simple. I have zero technical indicators on my chart anymore, and I trade only with this. As a matter of fact, I'm currently in the middle of a 5K to 100K trading challenge on YouTube where I'm showcasing my trades live, and I'm only just trading S&P futures for that, to showcase how I do this and only using these tools. Now, again, resilience is just designed to look at the S&P lagging behind what the market cap weighted sum of the stocks is doing. And that gives you a little bit of heads up as to what the S&P is likely to do because it's kind of connected to the stocks basket by like a rubber band. It'll trade on its own, but eventually they're going to snap back into place. So as you see, like our tools are slightly different than maybe what you're used to seeing, right? A lot of technical indicators are just basic math. They take the price, filter it through an equation or something and put it out. All of our information, especially liquidity maps, are fully calculated from options. It doesn't even look at the price. No historic price, no anything. It's a very purist approach of looking at data that's only relevant to what you're looking at, and that's it. An example being resilience, right? It's not something that you use all the time. It's something that you use in relation to trading between the S&P's open and close. It's specifically designed to target just this. So when you have indicators that specifically target a certain thing and aren't trying to give you a signal all the time, then they're more powerful because you have conditions where they work better in. You know, if you're using like RSIs and all kind of other traditional technical analysis, they're always trying to give you signals at all points in the day. What there's a catalyst, what if Jay Powell is speaking? There are times when we use our tools and times when we don't. And that is actually the most powerful part of the presentation is these little lights at the bottom. These alerts tell you not only when to not use the tools or when to not use any tools, but also how big to bet. Yellow is green is go, yellow is half, red is don't go. And so you even know when the integrity of your tools is gone. None of your technical indicators out there come with a flag that say, no, turn me off, don't use me right now. They say it's a go. RSI oversold, go ahead and bot. Volume profile, VWAP, take a long here, take a short. It's always trying to throw signals at you where we have ways to say there's not a good signal. Don't use it in general, if it makes any sense. So somebody said, can this be used on any stock? Anything that has options, we can draw a liquidity map for. Resilience is an index-only tool. DD is an index-only tool. But we have something for pretty much everything out there. We have tools that work for all kinds of different situations. Like I said, we have 15 different things, and I've shown you 3 of them. Looking at options on futures or underlying stocks or ETFs. Your question, Kent said, somebody says, is a neutral zone the rectangle with no highlighting, the volatility trigger, or zero gamma, where gamma switches from positive to negative going downward? So let's talk about gamma in a little bit. The gamma of the sellers of the options, right? They're the ones that are trying to buy and sell the stock to neutralize their sold options risk. That's what hedge pressure is. So hedge pressure, which is that blue line I showed you, this is the gamma positive of the options dealers themselves who sell the options to market makers. This is gamma negative down here. So this is the maximum or the peak gamma of dealer options sold to market makers of the stock. So this is their risk point. So if it's above here, the gamma is positive. So the net order flow of longing stocks of calls in the money is going to be positive, right? So you see that longing push that just accelerates away from there and vice versa the other way around. In the middle, if you think of it like what the zones are, according to your question, let me draw this. If a bull zone is where overwhelmingly we've found from the algorithm that a trader is long against the market maker who's short the shares, the market maker is the one that bought the calls to hedge. The calls are weighted by delta, which means that they're neutral. And then there's a market maker over here of the option themselves that sold those calls to this guy. So this is market maker 1. This person's trading the stocks between you and everyone else, the trader. You're long, dealer of the stock is short with a call. That is neutralized to 0. The seller of the option has risk. And if the calls go in the money, they have to long the stock at a rate of delta to neutralize their risk. If you go down here where puts are tilting the scale, the sellers of the puts have to, they have to short the stock because the puts are in the money. So what the bull zone and bear zone is where bulls are winning against the house. Bear zone is when bears are winning against the house. The no zone in the middle is where the house is winning against everybody. It's the maximum, or we call it the sum of least risk of all dealers of the underlying stock, which means the casino is at maximum risk-free with minimum effort of delta hedging. Essentially means when markets are neutral, the bulls are losing, all these longs are upside down, and all these shorts are upside down. When you hit the middle, the market just hangs like it's just pudding, like you're just walking through a thick molasses. The market makers have no incentive to move it from there. Every moment the markets are here in the middle, the call sellers are making theta, the put sellers are making theta. So both sides of the market making equation are either banking or neutral here, and the traders are the ones that are losing. It's a maximum squeeze point of all traders who aren't trading against somebody else and are trading against the house. Does that answer your question, Daniel? So it's not necessarily negative gamma territory, because hedge pressure is going to be where your gamma positive and negative is on the dealer side. Remember, this is just dealer options sold to dealers. We only look at this relationship. We filter out the majority of the options, believe it or not, from even consideration. Our algorithm doesn't look at all the options. What makes our tools different than other people that look at gamma or GEX or things like that is that they look at the entire landscape of options like it's useful. And if I were to draw the entire landscape of options, like hedge pressure is built on all options that exist in time and price, it's an entire spectrum of strikes, expirations, and certain algorithms out there will look at every option like it matters. We're like plucking only those dealer positions. It's like drawing dots on a blanket. We're not looking at everything. We're only looking at the trades between the market makers. That's it. And so knowing what to pluck from the entire options landscape is the rocket for the scooter. That's the different thing that we do. It's just dealer against dealer because they're going to balance their risk by longing and shorting the market. It's forced hand trading. So we were like, if we just look at what the dealers are doing, we can see where they're forced to buy and sell. You can't predict what traders are going to do, right? They're going to do random stuff every day. But market makers have a procedure they follow, don't they? Delta hedging, gamma hedging. So the forced hand side of the market is what we wanted to look at. Where are they always longing and shorting? So it's powerful information, right? If you're in this bear zone, then you just have a natural pressure that's shorting faster than it's longing. If you were to break into the bull zone, it would likely accelerate as you kick some calls in the money and people start squeezing each other. So the idea is that if you find where the neutralization point is, it's really useful. So somebody asked another question. This can be used with anything with options. You can calculate a liquidity map with anything that has options, any stock, any ETF, anything. Okay, good deal. With options on futures, it does. But the thing is that we have a different procedure that we do. For futures, you can take these levels in QQQ, for instance, and convert them to NASDAQ levels. Because and this is a whole different reason for why this happens. You can draw liquidity maps with futures options. We found out that if you use the ETF, it's actually a stronger, better signal because you just have more options to choose from. Futures options are thinner, less liquid, not as many of them. And so at the end of the day, using QQQ's hedge pressure and futures will pivot at the same exact spot is much stronger than using futures options themselves. The liquidity is so much lower, as Daniel Hyunyu just said, on options and futures. So the trick is that the more liquidity you have, the more dots on that sheet you'll have to pluck from. So you're going to get a better read, a better distribution, right? So we actually train our folks that are trading futures just to put your equities QQQ up here and your NASDAQ futures here, and you just look at them side by side. Pretty simple to do. And that's how I actually do it on my stream. I have SPY to the left and ES futures to the right. Last question. Rock seems to be great for zero DTEs. There are things we have that are perfect for zero DTEs. That bear zone push that we talked about, an example, as long as none of those alert lights turn red, if 96% of the time the back test says it ends up in the bear zone, just imagine, right? Right? Selling calls and buying calls. You see what I'm saying? This is a vertical credit spread. And as long as the market doesn't end up in here, then you made your premium on that options trade. You're making a bet on where it likely won't go. Does that make sense? So on zero DTEs, it's very unlikely to go there. Traders like Ashton and others in our group who work
Hey, Matt, did we lose you? I don't hear audio. You guys hear audio? Yeah, we lost sound. Give him a second. Maybe his connection got lost for a second. I must have lost connection. We'll give him a minute to come back in and get set up, and then we'll carry on with the greatness.
Yeah, Sean, his PC froze on him, so
Oh,
he's gonna reboot some things. But while he's gathering his computer and restarting, feel free to plug away with some questions in the Zoom chat here, guys, and
cool.
I'll step in and answer some questions. So, but I'll pick up right where Matt was leaving off here, and he was pretty much saying using the statistics to your advantage to essentially sell some options. So there was a question earlier asking about, what kind of strategy is this conducive for? Is it conducive for, futures or options or stock? And the answer is yes to all those. So my style of trading, I'm Ashton Nolan, by the way. I'm one of the partners of the company. I'm also an active trader myself, and I primarily trade with selling options. So selling for premium through credit spreads and iron condors and cover calls, cash secure puts, anything, basically anything that you can sell options on. I basically traded depending on the sentiment. So what Matt was showing there on his screen was betting on a particular day using 0-day options. And I primarily trade the SPX, by the way. I can sell a credit spread betting that the market doesn't go to a certain place. I'm not really direction biased in that regard. I'm more of a neutral directional trader. So using Rocket Scooter, you guys can imagine how beneficial and valuable this can be, especially as an option seller, because then we can use deltas and things along those lines to put that into our statistical advantage. But then you layer in Rocket Scooter here and basically saying that we bet the market doesn't go here today. That's that 0-day options can be stressful to trade sometimes, but whenever you have such a high statistical advantage, and with multiple layers of that, that eases a lot of that stress with these 0-day options. And pick your poison, right? Some people use it. I know in our community, maybe 0-day options aren't their flavor, which I get, I understand. Some people will use an entry barring any news event, like yesterday's news event. A lot of people actually chose to sit out, myself included. But any day with no news event, those statistical opportunities are very, very, very strong. And a lot of people use them they place the trade on a Tuesday and they'll go, 4 or 5 days out, 10 days out, whatever the case is. And they're just looking for a quick 20 to 30% in the trade and they get out, but they use the entries based on that particular day in Rocket Scooter. So there's a multitude of ways that you can use this in terms of actual strategy. Go ahead, Matt.
Hey, sorry about that, you guys. My computer actually just froze up for a hot second there. Yeah, appreciate you taking over and answering some questions. So let me show you guys something really quick. And this is going to feed into one more strategy that we have. We have something called monthly maps as well. And this is something we created for option sellers options traders in general, who wanted to know what is a good expiration to buy your swing trading options. Should I buy next week or 3 weeks out, 4 weeks out? What is the market going to look like in a month? Did you know what we can actually do? Since, when I talked about earlier, like our sheet with the dots on it, we look at all the options that exist in time and in space, essentially through price and time. And you can actually stretch out where that risk is based on every single date. Like you can utilize, again, we're using Black-Scholes and other types of correlations to create this. But what we're doing is we're looking at where our market maker risk changes over time. The liquidity map is a thing that updates every day and shows me where I can pivot the market on a daily basis. But what if I want to see what the market's going to look like in 2 months or 4 months? This is where monthly maps are born. And this tool alone is what brought Ash and I together to join forces. This is such a powerful thing that we made. It was almost crucial to have somebody that has that same mentality in the options world, who does the kind of trading he does to kind of team up with. What monthly maps has done, and let me show you what I use it for. Again, these are my real tweets. So this is what I was trying to show you guys earlier. I don't know if you could see on my screen really quick, but what I like to do is I like to draw. These are the major pivots. This is the S&P since COVID. Market rallied, and these are my actual calls. And I don't really do the Babe Ruth point to the fence thing unless I'm very sure. I use our monthly maps tool to call major pivots in the market. And these are the tweets I made with the timestamp. You can go see them. They're still there. I never delete a single tweet. So like essentially back here in February, after COVID, people thought the market was going to sell off. And I was still saying the market's probably going to S&P 6,000 in 4 years. It's that strongly bullish. And then right up at the top, when monthly maps started showing us that the market was pivoting away, this is how powerful the technique is. This is the first time in as long as I can remember that I'm seeing a possible short-term correction in the market. The day that the recession started and the sell-off started, literally that day, not this week, not these months, not that month of selling, this particular day is when I said it's a short-term correction. Volatility is going to take over this month and likely this quarter. I saw 3 months out using just monthly maps. And everyone in our community is just saying this is the high. And that actually happened. Right here, I tweeted that here's a 2-month bear market rally potential. The bottom is in for now. And we rallied for exactly 2 months, believe it or not, this 2-month rally in the middle of the sell. This is the S&P daily chart. Right here on October 17th, 2022, on this green candle, I'm calling a bottom for 2022 and a rally through mid-January, genuine buying, and the bear market doesn't even get nasty again until Q2, summer for lower lows. 9 months away from this point in time, we said the bear market was continuing to go. I mean, the bull market was continuing to go, and this is the bottom for the year. People thought I was dumb and I did not know what I was talking about in every podcast and show that I was on. I was screaming that the bear market was over and no one listened. And usually when you're right, people think you're dumb. And that's the funniest thing about monthly maps is it just shows you where the dealer's risk is shifting around. If they're shifting, we're starting to buy against the herd. If they're shifting here, we're starting to sell against the herd. It just shows you what's going on. And then right here at 4,400, I said the recession is over. And we're trading almost at highs right now, aren't we? Right? We're pushing to all-time highs and higher. And so let me show you how we read that. Again, I like to do this to kind of show off making these calls, but we are almost not on the wrong side of the market really ever. And I'm not saying that to say that you're using Rocket Scooter is a promise you'll make all your trades win. That's not the case at all. So don't let this presentation convince you that that's what I'm saying. But we know every day market has been trading higher and higher and higher. We're still bullish. We're still bullish. We're still bullish. That DD ratio is strong at 98. The monthly maps are showing bullishness in the future. DD ratio is today's trade, today's setup. Monthly map is how it looks like a year out. So the market is bullish through February of 2024 and even onward through March because of this. And let me show you how you read this. Again, it's just a neat thing. And we have a little tool that shows you how to do this. And this is a little cheat sheet for it. What you're looking at is the changing and the sloping of the bull and bear zones as you stretch them out over time. This incorporates other Greeks that have to do with time and how that risk changes over time. And I'll give you kind of a neat example. So say like if this is Monday, Tuesday, and Wednesday, and price is just right here where this red dot is, and price stays the same for 3 days. As you see on this day, it's going to be a bullish day. You're in a bull zone. This day, you're not in a bull zone, and that day, you're not in a bull zone. As a matter of fact, as the days go by, you're further out of a bull zone. It's less bullish over time because you're not even have bulls. You don't have calls in the money overweighing, the market anymore like you did in this bull zone. So all things being equal, if the price doesn't change for 3 days, it becomes less and less bullish. Y'all see how that works? So it actually is our bulls exiting positions over those days. But on this particular day, I can see that 3 days later, those bulls are going to be exiting their position, whether those options expire or whatever. But that's typically what it's showing is the changing dynamic of the landscape in time. So you can look at bull and bear zone the same way to show that bulls are either longing more over time or exiting their longs over time. Bears are shorting more over time. Bears are exiting more over time. So like in our language, a bull is somebody that longs the stock, right? A bear is someone that shorts the stock. It's money into the investment. And it's whether they're getting in heavier, getting out of heavier. Another neat thing is that monthly maps can predict when the market's going to be volatile and when it's not. As the zones get further and further apart, as bulls and bears disagree further on where they're bullish and bearish, that means the market is less liquid or more volatile, right? As liquidity is the inverse of volatility, right? We all know, how do you predict volatility? Well, if bulls and bears are really far apart, then this particular day from this point in time is a volatile day. Hey, maybe that's Fed day. So you can tell not only bulls and bears strengthening or weakening their position over time, you can also tell if the market's expecting volatility because efficient market hypothesis states that all information is priced in, and even inside information that's priced in is visible to you now through this tool. So anything that can be traded against is known. Let's read the monthly maps today. Let me show you how it works. You just go over here. You're going to go and we're going to type in, let's do SPY, right? Let's do the main S&P 500. Let's load up SPY. All I do is I go here. So there's, as you see, this is the daily liquidity map. Let me just click monthly map. And this is what SPY's doing going forward. Now, it's kind of jumbled and hard to read, but let me show you. And again, this is just, you know, take it with a grain of salt, but let me show you how you read this, right? It looks a little jumbled, but if you were to actually draw a line where these bull zone bottoms are, you can see I'm just kind of drawing that dark gray area. You can see that the separation between bull and bear zone over time is basically sloping down, right? All the bull stuff is becoming more and more and more deeper in the money. If price were to stay here over time, then you've got more and more and more calls that are in the money. So therefore, people are going to be buying dips along that way. Bulls are becoming more bullish. And so if you read from the little cheat sheet that we give you, it's telling that exact same thing. If the bottom of the bull zone is sloping down, bulls are just longing more. So there is no fear, even at highs, that between now and February or the end of January, that bulls are still going to be longing this market. How cool is that? I'm bullish right now. I'm actually very bullish right now. Based on monthly map and ED, all of those things are strongly bullish. And so the market keeps, yesterday, I took a trade on the FOMC. I made a couple $1,000. I longed before the FOMC because monthly maps told me it doesn't matter what the Fed's going to do. They're probably not going to change the rates. The market's likely going to respond very bullish as long as they don't come out and change the rates. So I made a gamble on the rates not changing, and the market just went straight up, didn't it, on FOMC? And I made that bet purely on knowledge that monthly maps and DD showed a bull market. Unless the Fed changed rates by 25 or 50 basis points, which is very unlikely because all their conversations said they wouldn't, then I made just a strong bet on the health of the market. Now, one more thing is to take a look at what the bears are doing. Like, what's the short side of the market doing? And again, well, I did draw what the bulls are doing with this red line. Let me go ahead and just delete all that and look at the bear side. The top of these light gray boxes, you can see that in general, the light gray boxes where the major zones are actually trending down, despite a couple of excursions. But in general, it's also trending down. So what that actually means is shorts that are in the market over time are getting squeezed as well. So not only do you have bulls willing to buy every dip, you have shorts willing to or wanting to exit over time as well. You have twofold power to this rally, and that's why it's going straight up. Bulls are longing and shorts are exiting. They're both buying this market. And that's a really neat way to see that particular dynamic. And also, remember when I told you about volatility, right? That you can use monthly maps to predict if the market's going to be volatile or not. Tell me right now that the VIX futures didn't just hit 4-year lows, right? Have y'all been seeing that today? Remember, the VIX is just completely collapsing. If the zones are pinching together, then volatility is decreasing. There is almost no space between bull and bear zones. They are right on top of each other. There's no volatility in this market weeks out from now. Isn't that crazy? It's showing you exactly the same thing. People are like, okay, it's going up. It must come down. There is no volatility anywhere. Even going out in time, there's very little space between. I mean, it's separated by like 30, 40 points over weeks of time. It's not a lot of volatility. So even monthly map is telling you the market's not going to just spontaneously have waves and cycles in it like it's been having. This is volatility here. This market is clean and probably going to consolidate and keep going. That no volatility was present there, and everybody trying to short every little pop there got burned because there's no volatility. You see how that works? And again, the cheat sheet shows you how to read these things. If they're starting to fan out, you're going to see some volatility. So one of the things I like to do with these demonstrations is like throw me a random stock ticker, because I know it's always cool to show up and like bring your best presentation or whatever. But like throw me a random ticker, somebody in this audience, and I'll just read it for you right now. And we'll do 3 or 4 of them right out the door. I'll take the first 5 that are posted if you guys want to type them up. And no penny stocks or anything like that, like something like real. When you say AMAZ, I'm sure you mean Amazon. Type the ticker for me. Okay. Gotcha. Okay, so let's look at Amazon right here, and let's just kind of pick out what the monthly map is telling me. From here, Amazon is bulls are longing more, shorts are Xing more, and Amazon is likely to continue to squeeze higher. Somewhere inside of here, though, there's a big space. So you have to ask yourself what's going on there, that there's likely some volatility 3 weeks out, kind of at the end of the year. See how that works? So in general, with Amazon sloping down, the volatility is getting slightly bigger here and slightly bigger there. You can see that Amazon is still going to likely parabolically squeeze over the next 2 weeks. And so now if I'm trading options or trading anything, I have that in my mindset that all dips are likely going to get bought up for a couple of weeks. And of course, on the daily mode here, we didn't talk about like hedge pressure breaks and other things, but we're not using the liquidity map right now, but you would be able to do your liquidity maps at the open, which is, I guess, a different conversation on how to handle or how to trade this. But inside of here, this is that bull zone is that support, which we didn't even get close to. So there was really no actionable trade off of that. A couple more. I'm just reading what you guys wrote. NVIDIA. Okay, NVIDIA. So like and again, today was a really interesting day because the market was kind of selling midday post-Fed. You can see that one of the neatest things about these hedge pressure numbers, and I'll show you right here, is that anytime you interact with hedge pressure, this is how I'm telling you that you know that we're doing our homework the right way. You see this volume spike right here? That's not a coincidence. What these hedge pressure numbers actually are is they're the peak gamma of options sold to dealers, means it's the maximum amount of delta hedging. This volume spike is no coincidence. Hedge pressures predict high volume before they happen. It's like predicting volume profile, high volume nodes before they happen. Anytime you interact with hedge pressure, do you see does everyone see on my screen how this volume is spiking? Yes, type yes if you can see it. You're predicting high volume pivots at 9:30 in the morning when these are calculated. Anytime you interact with these hedge pressures, look at that volume that comes out of nowhere. This is your market maker's activity. That's how we've extracted it. That tells you the numbers are right. Any stock I'm going to type in that touches hedge pressure, you're going to see that same effect. So now you've taken all the different prices you can trade at and really isolated very important key pivot levels. Again, other powerful information. Okay. As you see with Amazon, with NVIDIA right now, throughout the day, there's different places it can pivot from. You can see that this BLD right here, there's that V-shaped wave between here, really was actionable, maybe to short from there or to long from there. But you can see that anyway. So a couple more things. IWM, so the Russell, right? Look at that every day. I know some of you guys had said. Let's look at the Russell first and foremost. Monthly map. Let's say like Russell looks like everything else. Russell, bull side slipping down, bear side slipping down. Again, Russell is exhibiting elements of a short squeeze and continuing rally, which is great. Okay. Daily mode, Russell, BLD is a general push to the upside, supporting at monthly hedge pressure. Inside of here, it would have been actionable there. It didn't touch this yellow line, which is where my entry points are. The open price supporting is a resistance. So the open price supporting is a trade as well. 1A is open to some gap fill or something. So this leg is actually that leg and that leg right there. Okay, Uber, a couple more. So every day, right, I'm just looking at stocks and making judgment calls based on what they're going to do. Now, Uber is, again, this is the end of the day, but at the beginning of the day, it was actually what's a BSU. So it's the map will show you where it is right now. Where Uber opened, it'll be called a BSU. So it actually shows right here. Uber has actionable pivots off of hedge pressure and between the yellow and blue lines. So like between the yellow and blue lines are actionable trades. And again, when you cross through hedge pressure or get close to it, there's always a volume spike when you get there. There's no coincidence there. All of these taps here or all these major volume spikes, that's dealer positioning. You might have thought that was always random, like who's buying and selling that stuff. This is the dealer balancing act, which is very cool. There's your hedge pressure tap and there's a volume spike. There's your hedge pressure tap and there's your volume spike in Uber. So you see that these lines that are drawn are predicting volume at that price the minute you get there. This very powerful information. Who's making those trades? This dealer, it's balancing act. All the dealers are in a flurry right there to go gamma positive or negative. Pretty cool, right? So the neatest thing about it is that all the different places, you really just care about a couple of action points and you can ignore the noise in the middle. Okay, one more. I'm just going to run something up. Gene, sorry, I skipped yours. You said, what is it? JP Morgan. Okay, it's a GPM. Oh, and then of course, Uber. Let's see what Uber looks like in the month, right? Let's kind of do that. Now, Uber is a little interesting because the bulls are exiting and the bears are shorting harder. So in this, I'm sorry, bears are exiting, bulls are exiting, and Uber is looking to get some volatility over the next couple of weeks. So whatever we're looking at right now, this could probably stabilize and start to chop around a little bit. This rally is probably going to exhaust for a little bit. And I can see that because after this Friday, looks like Monday is sort of choppier, right? Okay. So not as strong. This might be kind of nearing the end of that first wave of the run up. JPM, last one. Okay. And I've been doing this for a while. You get pretty good at reading this. Ooh, I like it when it does this. JP Morgan all over the place. So one of the neat things to see is like you got bull zone sloping down, bear zone pivoting up. So the banks are likely to top out here and start to find some resistance in the next 2 weeks. So I think that, at least for the next week or so, we're still strong on the rally side, maybe higher highs before it starts to peak out. So things still look good for about 2 weeks. And then you can see that there's a little bit of volatility going forward. Pretty neat, right? So in reality, there's the bull long up, there's the hedge pressure support, there's the hedge pressure support. We go, and there's your volume spike when you touch hedge pressure. Again, these numbers are calculated at 9:30 when the market opens, and they stay there all day. Does Rocket Scooter help identify reversals, directions to market close? As a matter of fact, Daniel, we've statistically proven that after 2 p.m. Eastern, because of the 0-day run-up and expiration, the markets are 100% statistically random as to where they close. Because of the lack of understanding what the open interest of the options are that far into the day, and the willingness of those holding them to either exercise for the shares or close out for cash, you cannot trade the last 2 hours of the day once Chicago and New York come back from lunch and start closing out their books on a daily basis. We stop all analysis at 2 p.m. and we really suggest that every retail trader on the planet does the same. Since they created 0-day options that now expire on index products on a daily basis, that run up, that randomness happens on a daily basis now. We have a rule on our platform that reminds you that it's 2 p.m., no trade. Red means get out. So I promise, all of this power hour stuff that people have tried to do, Daniel, over the years, we actually mathematically prove that it's random. Because all of our rules don't hold that statistical edge they have at that point. And the justification is pretty simple. Once volume starts to increase past 2 o'clock, you see the volumes growing. These are just people buying and selling shares as options are expiring, right? You don't know what people are going to do in that mode. It is completely random. And the dealers are just going to respond to the willingness of people to buy. What if there's 10 million calls in the money? What percentage of those are going to actually buy the shares? That's going to push the stock market up. What percentage of those are just going to want the cash, and the options are going to just close out with no trade? Then the market's going to go nowhere. Because you can't know that, then don't know. We call it being market agnostic. Because you can't know, don't guess. Right? So we don't trade past 2. And that's a very solid rule. And we proved it with math. You shouldn't. Any more questions? Can I do the NQ, or do you have to use QQQ? So when I trade QQQ, and Daniel, that makes sense, right? Because of that effect, technical indicators, if you pick one and you measure what they say you should do, and you measure that over 100 iterations or trades, you will find out that you couldn't guess where the market was going to close, and you really can't. And the market makers don't even know. That's the best part. They don't know. They're responding to what we're doing. So there's no rhyme or reason to the end of the day. And the rule of thumb is once volume starts ramping up, on a daily basis, like a 1-minute chart, volume tends to do this and then start ramping up towards the end of the day. It's like a J shape. The ramp up usually starts at about 2. And again, that's when New York gets back from lunch and Chicago gets back from lunch and that. So if I'm trading NQ, yeah, I'm going to run QQQ. I'll have NQ up on the side. I'll run my liquidity map for QQQ. Same rules apply. So anytime you're trading any kind of futures product like oil, you can run the liquidity map to the USO. The ETFs and ETNs have better, stronger distributions where it's a lot cleaner than the futures, just because there's more liquid. More liquid means more data points, right? More options to choose from. And therefore, you're going to have a cleaner read of the market, Derek. Great question. So we train people to just put two charts side by side. As a matter of fact, let me show you what mine actually looks like. Let me load my layout here. I trade futures and pretty much only futures, and it looks exactly like this. I'm going to trade the S&P futures right here. I'll have my S&P liquidity map right there, and I'll have a VIX liquidity map down here. And I literally look at just these three things, all on 1 minute charts. We don't even use time to trade with. It's just the levels. And so just like you said, where this pivots, that pivots. And there's also accompanying volume, right? On the S&P, here's your hitting hedge pressure and there's a volume spike. Well, we'll look what happened at the beginning of the day, right? Let's find this. Where SPY is hitting monthly hedge pressure right here. Look at futures. Futures has a volume spike at the same spot in time that SPY has a volume spike right here. So you see how they're mirroring each other on their risk, right? We just found that equities will have much stronger maps. Cool. Any other questions you guys have about that? So those four things together, again, when I tell you that I use monthly maps to pivot the market, you can't argue with a tweet that's still there to this day. But calling a high here because the maps are pivoting lower, calling a low here because the maps are pivoting higher. Just like I was showing you, like JP Morgan has probably got a week or two still bullish. It's like as this bear market's persisting, we're seeing in this selling, wait, the map is starting to stabilize and look bullish. Okay, and now this trading day happens. Okay, maps are bullish for like 2 months. Yeah, same for RTY. You'll use the IWM to trade with, Sean. Yes. So major calls are right here. Right when the Fitch downgrade happened, the map got shattered and it was no longer beautiful. And then it just kind of like died out. Let me show you what like a clean monthly map looks like. So remember in October, we were getting a little nervous that the market was still going to trade lower as the bull side was vacating the position. We had that strong volatility. You see how the bullish side is that way and the bearish side, and it's anticipating all this volatility. This is what it looked like towards the middle of October, right? This is the S&P in general. Oops. And so as you see, as the S&P has shifted, it's no longer showing that. Probably in the middle of October, which is about right here, we saw that same flush potential. It traded down for like 3 days. And then 3 days later, the map went right back to tightening up and we were back to being bullish. So we had this like warning sign. We haven't seen signs of bullish liquidation for a while. The market sold off for 3 more days and the map flipped around and rallied and we caught that as well. We've been bullish ever since. So you can see that like, you just see, like I said, I always tweet all my calls, but you can see them there as well. Is SPX as good as SPY? It is likely as good as SPY because the options are there. But again, we just use SPY because our data feed is from Opera. So we just use SPY options for SPX. They all pivot at the same spot. Great question. Okay. So to sum up, what it is that we do here, some of the rest of the tools, we have all kind of stuff that exploits different things in futures. Future specific rules, future specific indicators, all kind of stuff besides just these 4 tools we shared. Like I said, we have 15 major tools that are all cool like this and different than what's out there. And so as you come through and like learn our stuff or go through our program, you can learn everything it is that we do and we train you on it and we give you all the tools that you need to kind of utilize this and add this stuff to your toolbox. It's really neat to be able to double check some decision you want to make based on, well, is the market really bullish or bearish? Or what's that DD number say? Or is the liquidity map today bullish? The market's oversold. Maybe I should buy. Ooh, well, it just broke hedge pressure. Maybe not. You get a second layer of the market that you don't normally look at. And that's really called confluence, right? If you're trying to buy or sell anything, just looking at price action alone, why not use what we give you in options to get that other side of that same risk landscape to give yourself a whole new layer of analysis to what you're already doing, right? It's just a second look. The other is the dark side of the moon. You're looking at the light side, here's the dark side. So you get the whole picture. And that's what we think is really important because a lot of that information has never really been available to traders before. So that's kind of where I'm going to wrap up. I appreciate you guys jumping into that lightning round. I love doing those. They're really fun. It kind of can show that when you get a lot of practice on the spot, you can just really look at it and see it really quick. And I've been doing this for a very long time. You just throw out a ticker and 5 seconds later, I kind of know what I want to do, right? And so in trading, speed is everything. You don't see me analyzing JP Morgan with like 4 different time frames and zooming in, zooming out, taking 30 minutes to analyze the chart, drawing trend lines, drawing patterns. I just look at it and I know what I want to do. Bullish for another week or two. I'm going to buy some dips if I find them. Did the hedge pressure right for FOMC yesterday give you a clue of the direction of the move? We don't trade during events. Great question. An event is random. When humans do random things, don't try to use any indication of the landscape of the market to try to guess what's going to happen. We've learned statistically, just like at 2 p.m., when humans are doing things, it's random. When humans are responding to FOMC, it's random as well. You can trade off of those levels, but those levels will never tell you the outcome of the event. And again, we've proven that as well, which is neat. You just kind of sit out through it. Don't try to flip a coin on what the FOMC is going to do or what CPI is going to do. After the event happens, then you look for those to be pivots. But just because we're trading above hedge pressure, I don't ever say, well, that's probably because it's going to be bullish on FOMC. We train everybody to be out of your positions leading into an event, which is a smart way to trade. You want to trade when there's no event, no volatility, no craziness, and the market's just ebbing and flowing against the wind that's there, which is most days. 96% of days, there's no catalyst. So those days when there's a big event, it's not where you really make your money as a trader. I make my money 10 or 15 points at a time in the S&P. While I did long yesterday's coin flip on the S&P on Fed, it was a coin flip and I knew it. So I bet small. But if I want to play a real game on the market, it's going to be, I'm going to bet bigger when there's no event, because that's going to be that. I want to trade when there's not randomness, right? When I know I can see what I see. So in a typical week, I trade personally futures. Ashton and other folks in our group trade options. So we have somebody that trades different things. I mostly day trade futures though, all my streams. You trade 0 DTE, verticals, and flies. Oh, cool. Yeah, Ashton will be your best friend to show you how to use a lot of this stuff for that. The tools help with trading earnings, or this is a news event. Again, a news event. No tool. Let me tell you guys this. I'm not just saying our tools. No tool will be able to predict earnings, news event, no tool. And I'm sure you all agree with that because you've seen that with your own trading. Nothing out there, including the weakest thing, which is price action, can predict the outcome of an event. Even if the event comes out beating the expectation or losing the expectation, you still can never predict how people are going to react to that, right? Somebody just wrote me, you're right. A couple of people said, you're right, you're right. Exactly. No tool can predict the outcome of an event. Don't straddle an event. Don't strangle an event. Don't try to trade events. We've learned that you don't. Trade around them, before them, after them, but during them, it is a gamble every time. And even our tools, which we know are superior to price action, because we're predicting volume. Price action can't predict anything. Even that you can predict volume, you can't predict the price direction during an event. So the best thing to do is just to sit out, and we do. Why put your portfolio to the risk of coin flips and gambles? Trade when you know your trading tools are strong, and put them aside when they're weak. Does that make sense? Okay. So do you guys want to take it over? It's kind of end of the presentation. Anyone else have anything?
That was awesome. That was really great. Guys, thanks so much for coming out and hanging out with us. Go ahead and ask your questions, guys. If you have other questions, they're going to go ahead and wrap up and tell you their slick deal that they've got for us. We've managed to get a discount for everybody, so make sure we honor the community, and so go ahead and take it away. Show them what you got for them, and then we'll wrap up.
Yeah, sure. So in our platform, what you get with our community and our tools and everything is a full-on trading platform. At this time, you can actually trade futures in it. As time goes by, we're going to open up more broker connections to trade with. But at least for an informational platform, you get all the tools and indicators pre-programmed in. You get stock data, options data. You can opt in to get futures data as well for a small fee. You get a 6-week training program, which all the tools, videos are you're trained in videos. I mean, they're very quick. We try to make it as concise and easy as possible. It's not going to be 150 videos that are 30 minutes a piece. Our videos, we try to make it pretty quick, like 5 to 10 minutes each. I just went through 4 of our most major tools to kind of show you how I use them in less than an hour. We try to make it like that. You get in, you can learn them quick, and then the community can support and help you learn faster. And we live stream every day as well. I do, and Ashton does. All these automated tools are automatic for you. They're automatically drawn. They just load up and give you what you want, the monthly maps, liquidity maps, everything. We have a scanner, which I didn't even go through and show, which I probably should show very quickly. Actually, let's show it real quick. So imagine that, like, and I didn't show this earlier because this is one of our coolest features, but imagine that you, that you like trading a certain setup. Like imagine that like bull long up is your favorite setup. I didn't even show you that you can do this, but you can actually go through and set up the condition that you can actually pick just those setups to find. And then you can find stocks that are sitting right on those actual pivots. Here's the bull long up, and here's Google, which is sitting right at hedge pressure. I'm ready to find Google right at its launch point on that bull long up setup. So I could find stocks that are matching each one of these legs by building it in the scanner. A whole nother way to find plays if you're trading. You want to find breakout plays like hedge pressure breaks? Okay, let's find one, right? Hedge pressure breaks typically create squeezes. Here's a hedge pressure break. Let's look at AMC today, right at the top of the list. And we had a hedge pressure break to the downside, which created some momentum. And as it's breaking, you get a list of breakout plays that show up every single day. So now you can sort by the liquidity. I can't believe I skipped one of our best features, but that is actually a really cool feature that a lot of the options, because I trade futures, I'm not picking stocks. The other guys here use it a lot. But yeah, so if I'm picking stocks, that's how I'm doing it. I've got a lot of cool ways to show you how to pick runners, balance plays, breakout plays, everything. We have a daily Zoom coaching session, which we do at the end of the day, which is going to start in just a little bit. We have Ashton does options trading sessions. We have tons of options trading lessons and all kind of stuff. Full Discord unlock. You get a full community, and that's basically it. And so we have a lifetime, one-time purchase of the platform, which comes with all the tools we have, all the tools we'll ever make in the future. Your data stuff purchased, so your data feeds for options and stocks covered for life, and then of course you get all the access to everything we're ever going to make. And it's one payment. And so this is what we normally do. It's a $4,000 for the platform, for the training. And we're giving you guys $1,000 off and making it $3,000 for this, this awesome deal that we're doing with the NS Trading Academy. So I think they're going to post the link in there for you guys to check it out, to sign it up. You know, I think we passed 5,000 members to our 5,000 user accounts to our platform in the first year since we've launched. We've been growing like wildfire, so our prices have been going up. And that's kind of one of the neat things about it. You know, lifetime members, there's probably, I don't know, maybe like 1,000 lifetime members in the community already. So it's a big, big community. You're going to have a fun time hanging out with our group, getting to know everybody. Tons of traders you can, you know, hang out with, learn from. They all do all kind of different stuff. Our Discord has 5,510 members in it at this time. I'll let
awesome.
NS, you guys want to take it from here about, there are some more questions in chat.
Yeah, you guys are welcome to ask questions and so on. The live streams, that is, what time do you guys run those? And is that available to the members then, I assume? Is it available to anybody else? How does that work?
Ashton's live stream is for members only. I do a 1 hour-ish live stream on YouTube, but the live stream I do, which isn't training, it just shows my trades. The training I do is for members only as well. And that's at the end of the day when markets close.
Nice.
So members only will get access to the daily training sessions for both Ashton and myself.
Very cool.
The special price, somebody's asking how long you guys are honoring the special.
I don't know. They didn't give me that kind of information. It's really, you know, I mean, as long as they want to run it, really. So.
Yeah. This is lifetime as well. Well, I say that in general. My thought was that the special was going to run for a week. So
yeah,
I think that was what
usually that's about what we do. Yeah.
And definitely. Well, what's neat, and I'll tell you guys something really neat. We're about to launch a bigger marketplace where our platform's going to have more tools you can buy in addition to our tools we have. So we're going to have other vendors bring in other tools to the game as well. And again, you can buy those a la carte on top of lifetime, but we're going to have special deals and all kind of neat things for our lifetime members. We'll have that ability to, you know, like get early beta access and get special discounts and deals when we even go bigger with that. So lifetime is the best way to just be able to access everything we do and always be building. So as the years go by, Rocket Scooter has become a massive entity, even on top of what we've already built.
Yeah, very cool.
The link goes to a login page. not a purchase page. Let me check this out really quick.
Try that link. Yeah.
Okay. So what you need to do is click new account, create a new account and sign up with that. And then that's basically it. And you should be good to go. Does Rocket Scooter require significant CPU and RAM power? It absolutely does not, because we actually created our, there's a neat technology that Rocket Scooter platform works on that's actually something that no other platform does. Our calculations for our tools are actually done on a server. Most platforms like Thinkorswim or anyone else will do their calculations on the front end, and that's why they're sluggish and they're slow. If you don't have a fast computer, they won't work too well. We actually have computers, server computers calculating all the indicators, and they're broadcast to you via WebSocket connections, like streaming a YouTube video or a Netflix show. And so the calculations and the heavy CPU load is done by a server, and you just grab it on a browser. So it works in a browser. The platform you load up in a browser, and it's very nice and clean and fast, no matter what size hard drive or how fast your computer is or how much RAM you got.
That was going to be one of my questions was, system requirements. Does it work on PC, Mac, so on?
Works on
Sounds
all
like it's all
things,
web.
which is the best part. Yeah,
That's awesome.
yeah. So that's the way we did it for that particular reason. We didn't. We're trying to think of everything here, right? As the engineers of retail trading, we even thought about the experience of the user. These sophisticated calculations, we don't want you to have to go out and get a really crazy computer to be able to run them. Every other platform out there does front end calculations. Your browser is doing the work, or the software is doing the work. Our server computers do the work. And so whether you got a fast computer, slow computer, Mac, tablet, PC, whatever, it's the same experience for everybody. Can you take payment in cryptocurrency? We do not take payment in cryptocurrency. Sorry about that. What are some of the features you're planning in the future? Oh, well, let me tell you. We have something called rule assist mode. Imagine this. Imagine you have a rule that triggers, and we didn't even cover the alerts and the rules, but these are like my cautions not to trade the market. As you see, they're all red and yellow today, and the market just kind of went all over the place. Imagine if we have a rule that says sit out, and you come over here and all of a sudden the indicators just disappear from your screen because you opted to turn on rule assist. And rule assist will let you know, hey, where are my indicators? Oh, I shouldn't be using them because the rules that say don't use them turn out. It's 2 o'clock. My indicators disappeared. So it actually, you physically remove the indicators from your chart when you shouldn't be using them. These AI type rule assist features are like our next big push. How about what's the probability that liquidity map trade has worked over the last 365 days under these same conditions using a little machine learning and AI to give you a statistical probability? What if these arrows had probabilities next to them? That's our next step as well. So to create on the fly back tests of the probabilities of these moves based on other things like these other conditions would be like basically drawing an arrow with a probability next to it. So live statistics of what you believe the probability of the success of that play would be over the history of those same conditions. And that's a huge thing. And these are called AI assist and rule assist, and that's coming out this year. Can you use other platforms like NinjaTrader? Only our platform. Our tools that are calculated on a server only feed our platform. No offense to NinjaTrader, love them to death. They're just like everyone else. They're a 20-year-old, rickety stagecoach with a wheel falling off. They couldn't handle our calculations even if they wanted to, because those are very, 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 very early platforms that weren't designed to even take options data and the amount of data we do. We had to create the technology just to show that data on your platform. So we couldn't even have our indicators on someone else's platform if we wanted to. And that actually is the reason we built a trading platform, because no one else out there could be able to create liquidity maps that would display within the first minute of the day. Because no one can do it, I didn't just make tools on their platform. I had to build a platform to get my tools to everyone else. And that's why we ended up building a platform. Actually, a great story on that. So no downloading software. Daniel said you just come in via web browser. That's right. No downloading software, because who wants to download software from weirdos on the internet? No telling what you're going to get, right? Straight from the browser. So no downloads, no installs, no executables, no security risks, nothing. Like I said, we thought of everything. It's all cloud-based. What about the bond market? You can run liquidity maps on anything in the bond market. And we're in the TLT, look at the 20-year treasury. You can come straight in and see what the liquidity maps would look like if you want to. So you can run pretty much anything that has options or anything. You can come in here and I'm just looking at the like monthly maps as well. Oh, let me load that up. Like you can come in here and do whatever. So if it has options, you can definitely do something. I don't know. I think, oh, market's closed. I was like wondering why nothing was showing up. The market is closed, so it's not going to generate a liquidity map right now. But yeah, you can. So that's the TLT example. And have one. Does your platform come with the purchase? Absolutely. So the purchase is of the platform, and you get lifetime access to the training, the materials and tools, and everything else that we add into the platform in the future, all in one place. Do we offer free trials? We do not, unfortunately, offer free trials. We have a paid trial. But like I said, the paid trial won't afford you guys this deal, like this lifetime deal. It won't qualify for it. So you can do the trial, and then at the end of the trial, you can get the full price, which is the 4,000. Do I have an email address? Question about payment? Yeah. Email address, pretty simple. It's going to be matt@rocketscooter.com. I'll type it really quick. Send all your questions to me and let them. Can we export the options data for a period and a symbol for your own analysis? You cannot export our data to yourself for now. We've explored that possibility for like independent analysts, to be able to export their data, but it would require some infrastructure changes and some other exchange agreements. Like they're very particular about us letting data leave the platform to go to another platform. So it has to be a dead end with us at this time. And that's basically it. How do you backtest in this platform? We don't have a backtest module built in yet. Like I said, we just launched a year and a couple of months ago. A backtest feature will be something that we will be making this year as well. It's one of our ideas to have a backtest button, like all our little bottom widgets here. We'd have a backtest module that you can backtest like scanner settings and backtest liquidity maps and other things. So that'll be something that we'll have in the future as well. Backtesting strategies. So year 2 is going to be a very awesome revamp or a really awesome like feature add for the platform. Great question. A lot of ideas we have.
Amazing. Sounds like you guys got some really, really killer stuff already and just building on top of it. That's amazing. So really good stuff. Well, I think we
Oh, somebody said you can download options from Thinkorswim and TS. Well, you can download options, but you can only download so much and then they cut you off. So yeah. That's one thing is, yeah, you can do the RTD export in Thinkorswim and build yourself a small database. But after maybe 3 or 4 tickers of full options data, they shut off the feed and then you don't get any more. You have to close it open. What brokers and prop firms do you guys work with? So currently, like we're trying to add brokers like as part of the push that we have to connect to all kind of different brokers. Right now we have a futures broker connection with CQG. So we go through EdgeClear and a couple other brokers that go with that. So all the FCMs that they work with just for futures trading. Equities trading is our next push where you can actually trade on the platform itself through your own accounts, like connecting to TD and interactive brokers and other things are going to be like our pushes as well in this next year. Is there a monthly data feed? How much data is paid for? As part of your lifetime membership, we will pay your data for you. We're about to actually increase, and let me give you a little disclaimer there. We're about to increase our data capacity to like an even higher end candle data package. It's likely to cost about $3 a month though, so it's negligible. So if you bought the lifetime, you may be asked to pay like a $3 a month for your data. I mean, it's industry standard though. It's nothing outrageous for just candle data. And futures data costs $11 a month for top of book. And again, we don't make any money off of that. That's what the exchange is charging for both of those, by the way. The data currently right now is free. So we're like next month, we're going to up our data package to the $3 a month for candle. So at most, I mean, it's comparable with any other trading platform out there. Yeah. The options data, we don't currently charge you for it. We supply it. Cool.
Good stuff. Anybody have any other last minute questions? Anything else you can think of? Otherwise, you've got the link. Go to the site, grab it. This is really incredible stuff, unlike anything that we've ever seen. I know I was impressed about 105% of that presentation. So that was awesome. And really, really cool stuff. Very nice, guys.
Somebody says, are we going to get linked up with prop firms? Last question. I know. Sorry, Kate, they keep asking questions.
Oh, that's good.
We actually have an official partnership right now with Elite Trader Funding. We can get you a discount for their services. Down the road, we're going to opt into having a Rhythmic connection, which will allow you to do your prop trading inside of our platform as well. But that's going to be like maybe a year out or so. One of our goals is to allow prop trading inside of the platform. CQG doesn't support that. Rhythmic does. We have to revamp to build a Rhythmic connection. So the answer is one of these days, Carter. And that would be so you to trade inside of your prop firm inside of our platform. And that would be actually really cool.
Mm-hmm. Yeah, we're recording, guys. We'll get the recording out to you if you're here, and we'll get you the recording. Absolutely. I'm sure you'll want to go through and watch that again. It's good. Very cool.
Thanks, guys.
All right. Well, Matt, Adam, team, Ashton, thanks so much for coming in, guys. We really appreciate having you, and to all of our community, we all thank you for being here. This was really great. So good stuff. Thanks so much for being a part of it. Guys, get out there, go get a membership, lifetime access. It's worth every penny. So get in there, check it out. And if you need any help, Matt and his team are able to assist and help you with any questions that you have. If you send us a question, we're probably just going to send you there. So go ahead and refer your questions to these guys. They're the pros. So awesome. Thanks so much, guys. Appreciate it.
Thank you all for coming.
Yep. Awesome. Everybody have a fantastic weekend, and we'll catch you next time. Take care, everybody.